Back to those spiking bond yields, what's the rationale behind this particular spike that you're seeing, and will it rise, or rather will the rise in global bond yields really halt the rally in equities, and what are the implications, of course, of the same? Let's take these questions forward. We have with us via Anantha Nageswaran, EAC at PM member as well. Mr. Nageswaran, thanks so much for joining in. You know, globally, we are seeing bond yields rise, be it US, be it Japan, be it Germany as well, and India too. Why the rise according to you? Is it just pure inflationary fears?
Yeah, it is definitely the fear that central bankers are going to let inflation rip, and that they are succeeding in doing so. Bond investors are looking at commodity prices and overall asset prices in general. So in the last 10 years or so, central banks' monetary policies had only boosted asset prices, but not commodities and even general inflation. But this time, because commodities are rebounding in a big way, including food prices, bond investors are worried that general inflation must be on its way. So in that sense, they are more worried that central bankers are deliberately going to let inflation run ahead, well ahead of their targets, and naturally fixed income investors are going to be affected in real terms, and that is the real reason. It's both actually it's a fear that central bankers are actually succeeding in their mission.
Okay, but you know, it's a bit contradictory here, Mr. Nageswaran, because you know, Fed's Jerome Powell has said many a time he's, you know, vowed to keep monetary policy accommodative. The stance has been dovish for a very, very long time. So when is it that you actually see the Fed normalizing liquidity or monetary policy? And wouldn't you say that these fears are currently unfounded because purely because of the conviction and determination of the Fed?
Why do you find this contradictory in the first place?
No, purely because, you know, while the markets are fearing that perhaps the interest rate trajectory is going to change and the US Fed perhaps is going to act upon differently, and you're not going to have low rates, easy money for a long time to come. One fear on that hand and the Fed's promise on the other.
No, I think they are not worried that the Fed will change course and start to target inflation and bring it down. That is not their fear. Their fear is that the Fed would indeed remain accommodative, even as inflation rises. Of course, in an ideal world, the inflation doesn't rise too much beyond 2% and the Fed stays accommodative. See, all these years, the financial markets were very happy that the central banks remained accommodative, general inflation did not pick up, and they had the best of all worlds. But now, central bankers are indeed accommodative and planning to remain accommodative for a long time. At the same time, general inflation, they fear, is going to come back. So they are not worried that the central bankers will do a taper or even threaten to do a taper like in 2013. This time, the bond markets are throwing a tantrum because central bankers are not tapering. It's a non-taper tantrum, not a taper tantrum. So I think the real issue is that the central bankers might succeed too well in their aim to bring inflation. But you asked the question, are the fears unfounded? I would argue at the moment the fear is unfounded because it does require a sustained pickup in wage growth in order to drive inflation forward into a much higher level, around 3 or 4 or 5% in the United States, for example. We are not there yet. I still believe that a generalized inflation pickup is coming, but that is not until the second half of this decade. That is my current timing with all its uncertainties.
Fair enough. Anantha, if we talk about emerging markets and flows, especially to India in 2021, how do you see this kind of shaping up? We've been riding the wave, and how over the last year or so, what will, you know, the rise in US yields mean for that interest rate differential with India, the debt flows to India?
No, I think the rise in yield would be temporary. If it indeed became a sustained rise and central bankers are powerless to stem it, it would create such a big mayhem in all asset markets in the developed world that the consequences would be quite calamitous for the global financial markets, macroeconomics. Then all bets and discussions on capital flows, etc., would be moot. So I think this is a slow-moving train wreck, and eventually by 2030 you might see a new global monetary regime happening, but it's not going to happen overnight. So I think this time around they will double down on their liquidity and yield curve management policies, etc., and temporarily staunch the bloodbath in the bond market. But it will definitely store up inflation trouble down the road. But therefore, assuming that this is what is going to happen, I don't see capital flows to India being disrupted. If anything, I would think that they would accelerate. And not just in the portfolio flows, but also in the direct investment flow. So this is, of course, under the assumption that central bankers are able to put a cap on the bond yields and bring it down in the short run. So the problems of not having adequate capital flows, and in fact, if anything, even seeing capital flight, etc., is a story for much later in this decade, not right now.
Okay. Right. I'm going to get into this whole aspect, which in a sense has been the biggest puzzle for all of us. We've seen a decade of low liquidity, high liquidity and low interest rates. But inflation has not made a comeback. Even after GFC crisis, the amount of liquidity which has been printed is simply unprecedented. But that has not led to a formidable inflation coming back at a global level. So do you think right now we should not really focus on inflation coming back? Yes, we will see periodic ups and downs in commodity movements, but directionally, inflation is not going to come back?
I think in the in the world economy, and especially advanced economies, I do believe that a sustained pickup in inflation to rates much above 2% is possible only when labor bargaining power returns. And that is unlikely at this point in time. It requires a sustained political will and ability to stare down the capitalists who are also part of the Democratic Party in the United States right now. And the fear of technology is going to hold labor bargaining power back. And if you look at the impact of the pandemic on women employment in the developed world, it actually has made many of them unemployed and go back to their homes because children are not able to go to school, etc. In fact, you read just any search on the internet for women employment developed world, you will see plenty of articles talking about numbers between 3 and 6 million, etc. And to the extent, therefore, the pool of available labor supply has expanded rather than shrunk post-COVID. And therefore, I think a sustained pickup in wages is unlikely. And that is indeed the most important precondition, in my view, apart from commodity prices, for not only inflation acceleration, but sustained inflation acceleration. That is why I still think it is elusive, and it probably is a story for the second half of the decade and not right now.
Okay. At what point in time Reserve Bank of India will be forced to say that we are worried about inflation? Right now they are taking a measured step. We are looking at the inflation policy framework changing. What India is trying to do is that they are simply trying to control out of the 3 rates available, and that's, please correct me if I'm wrong, you are trying to, in a sense, balance the currency market, you're trying to balance the inflation, but you cannot balance the third variable, which is interest rates. At what point in time do you think they will be forced to rethink?
I mean, you can't have multiple objectives with only one instrument, the currency, the bond market, and the inflation rate, etc. And of course, to some extent, they're all intertwined. I think, and there are no right or wrong answers. Much will depend on the evolution of global commodity prices, especially for India. The oil price is indeed important, and therefore the central bank can only focus on what it can control. At the moment, I don't think the inflation framework is going to undergo a big change. It will still remain 4 plus or minus 2. So as long as I believe that the overall trend towards commodity prices remaining buoyant will continue, because I think the central bankers will somehow find a way to keep the liquidity flow going and manage multiple balls juggling. One is to keep the bond yields low and commodity prices at the same time, global inflation story continuing. And therefore, even developed world central bankers are trying to manage impossible set of objectives, and the same goes for RBI as well. So, long story short, to answer your question, whether India should start worrying about inflation, I really don't think that is going to be a worry until well into the second half of the next financial year. And even then, we do have the leeway all the way up to 6%. And I think we will stay within that band. It's very important to focus on what are the real drivers of inflation in India. And it is not so much monetary policy. It is really the fact that our regulation, I call it the LIC Raj. So we're talking about divesting from LIC. We should indeed divest from LIC, and that means licensing, inspection, and compliance Raj. And that is what is India's inflation problem, because we have major constraints on production. So India's inflation is a regulatory phenomenon, not a monetary phenomenon, and that is what we need to address. And there, the central bank is relatively powerless. And so, therefore, RBI, by and large, until the second half of this next financial year, will not have to worry much about the inflation outlook going above their back.
All right, Anantha, thanks so much for joining us this morning. Great speaking with you and getting a sense of how things are evolving.